Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with a video about the Shillers PE ratio and what it might be telling us about the current valuation of the market. So the next slide, this slide, you might have seen it before in the series about evaluating stocks. It's a 5-part series. I will put the links in the description down below, in which I said that saving is hard, investing is easy, but picking the right stocks is hard. If you pick the wrong one, you will lose money for sure, but picking the right ones is, hard. So how do you do that? In those videos, I explained that you should try to calculate the forward PE ratio. So you have to calculate the revenue growth rate for the next years and then calculate the PE ratio and see whether or not the current valuation of a stock is overvalued or undervalued. But remember what Charlie Munger said, so it's the first rule of dividend investing, and that is that you should always go for quality before dividend yield. I'm a dividend investor, but I don't buy a stock because it gives 7% dividend yield. I buy a stock because it is a good quality stock, and if it then happens to give a dividend yield of 7%, that's really great, but I'm not investing it for that 7%. I'm investing it for the dividends, plus the main reason is it's a very good company. And what is a good company according to Charlie Munger? Well, you have to understand the company, so you need to be able to explain it really easily. Does the company have a durable advantage? So it needs to have a moat, and you need to like, trust, or believe the management. That's not easy, of course, for us because we are normal people. We don't have the chance to speak with the management, of course. So that's a bit more difficult. Or you should go to the annual meetings and try to meet the management there, see whether or not you like them. But that's not that easy as well because there are a lot of people on those annual meetings. And then, do you like the price? And you need to have a margin of safety there as well. And that one is, of course, really important. And for me, the stock market now is hugely overpriced, especially stocks or companies that deal with artificial intelligence. They are really overpriced right now. That's my feeling, that's my opinion. It's not financial advice, but yeah, it's just what I feel. And the market is also extremely volatile. So it can be that the stock, there is news about a certain company and then the stock goes up 10%, and the next day the company owner says, yeah, but actually we didn't mean it like that. We only said that because it has a minor influence on that, and then it plummets with 12% on that news. So it's incredible how fast it goes right now on the stock market. In the 90s, it went up 3-4%, and then it was extremely volatile already. But now, it's double digits, so it's incredible. And another thing is, you can't rely on evaluations given by others. So I made a video on the 18th of March of 2024. No, I'm not going to put the description I am not going to put the link in the description down below because I just recently made a post about Avolta and Barclays, so go check that post out. There, the link for the video is in the post. So now the PE ratio versus the Shillers PE ratio. So the PE ratio is just the price divided by the earnings. So you can have the current PE or the forward PE, and you have to estimate the growth rate, so G, and then you have the formula of Graham. So the old style is 8.5 plus 2 times G, and G is the growth rate, of course. And then you have the new style of Graham, and then it's 7 plus G. For me, I am somewhere in the middle, so look at the videos in the description down below if you want to know more about that. The last video, not a lot of people watched the last video, but I think it's a really important one because there is an example. And the Shillers PE is way more complicated to calculate yourself, but yeah, you can you will see it on the next slide. You can go to websites online and they calculate it for you. You can see the graph there, and then you don't need to worry about doing it yourself. But it's really a good benchmark for sectors and whole markets. It was invented by Professor Robert Shiller of the Yale University, and there the earnings of the past 10 years are inflation adjusted and averaged. And then they are used to calculate the Shiller's PE ratio. So sometimes you can see it mentioned as the PE10 ratio as well, on some sites. So when you see that one, it's actually also the Shiller's PE. So why is this important? Well, the PE ratio is nice, but during economic expansions, companies have high profit margins and high earnings. So the PE ratio then becomes artificial low due to the higher earnings. And during recessions, it's just the other way around. So if you look at this graph, the most famous period here is, of course, the financial crash of 2008, 2009. And because of that, you actually had a recession. And the PE ratio shot up to 120. So quite high. And if you look at the Shiller's PE of the US market, so the previous one was the normal PE of the US market, and this is the Shiller's PE of the US market. There you see the opposite. So with the financial crisis, there, because of the depression, the Shiller's PE, that went actually down because you are calculating with the 10 previous years of earnings. So then you obviously see that the stocks are actually undervalued because they are below the historical average of 17.5. The previous slide, you see the average PE of American companies is 16.4, and right now, yeah, it's at 32.4, so it's rather high. And here it's 38.6. I don't know, it's 30.8 here, current 30.8, and here the current is 38.6. So actually on the crash of 2022 till October 23, it was the same height as now, and only before the dot-com crash it was even higher than now. In the previous decades, it never reached that value. Here it was around 33 when the big crash happened. So those points are really important. And if you look at the market's average, so 17.5, it was predicting at the times that it was really high at the markings of the previous slide, the crash of 1929 in October, and then the Great Depression followed in the 30s, in the 1930s. The dot-com crash of 2000, 2001, you also saw that. Then the Shiller's PE ratio was really high, and now it is really, yeah, obvious that there were two times that we hit more or less the same value, and we already had the dip in 2022 till October 2023. So the finance crash of 2008 was different. I already explained it. and probably that was a good time to buy stocks. And if you done that and you kept them till now, you have actually performed exceptionally well in the stock market. So is the market going to crash now that the Shillers PE ratio is that high? Who knows? Not me. I'm just careful and I will stay careful. I aim to buy companies that are not hyped but will be necessary in the future. Like I want to buy Nestle in the near future, hopefully at the end of this month. But I don't know when the wages are going to be paid in December. Last year it was on the 17th of December, so maybe it's this year a bit sooner as well, but I don't know for sure. I should ask our lady responsible for the paying out the wages. And I have a rule that I don't buy above 18, so a PE ratio of 18. I can't calculate the Shiller's PE ratio, so I'm just sticking to my PE ratio calculation, the 4 PE, with the growth rate that I think the company is going to have. So, in short, I try to keep in mind what Charlie Munger said, see in the beginning of the video, and the strange thing is that for most hyped stocks, the PE goes up even higher right now. So, for example, Nvidia, SAP, ISML, those valuations are really crazy, and that makes that they are even more overvalued than a couple of months ago. So, and this can be really a double-edged sword for investors. So, if they are not careful and something goes wrong, their numbers don't stack up the next quarter or something like that, the prices are going to tumble down very, very, very fast. And sadly enough, they will drag the rest of the market with them. So I will have losses as well on my stock portfolio, but I will keep on picking up companies with great valuations that are really necessary for the future as well. So I will do my best. And yeah, it's frightening because the only time that I've seen that happening, that the PE value of companies that are hyped go even higher and higher and higher, that was during the dot-com bubble in the 1997 till 1999, 2000, early 2000. Yeah, the sky was the limit for those companies, and then, yeah, they start crashing down, and that was no pretty sight. So just remember what Sir John Templeton in 1933 said: the investor who says this time is different, when in fact it is virtually a repeat of an earlier situation, has uttered among the four most costly words in the annals of investing. This time is different. And I hear that a lot on YouTube right now. I even see a lot of dividend investing channels going more and more towards growth investing. Not even dividend growth investing, but directly switching their whole portfolio towards more growth. And I think that's completely wrong. Switching strategy is very costly. It's yeah, and it's really dangerous trying to time the market as well. So, with that being said, I thank you for watching to this one. Please consider subscribing to my YouTube channel. Hitting that like button helps out the channel enormously as well. And thank you for watching this one, and see you on the next one on my YouTube channel. Bye.